What's good, everybody? We are now going to be doing like chapter 10, last some pages, like last two pages, and then we'll start with chapter 11, which is other payables and other receivables, like all your accrued and prepaid, that kind of stuff. This is basically your income and expense accounts, and we'll look into this as well. All right, one second. This, all right. So we stopped here last time, and they gave us no an example. And it starts with there's this guy who is making financial statements, and he later just you don't have to mention that, whatever. There's this guy who overstated, like he later discovered that he overvalued or overstated his closing inventory by $50. Okay, now let's just write the formula for cost of goods sold over here. So we have our opening inventory plus purchases minus closing inventory. Okay, this is cost of goods sold, and cost of goods sold is subtracted from your total sales, right? So we can basically say that the higher your closing inventory, the more the more your sales, the lesser your cost of sales. So your closing inventory, if it's high, then cost of goods sold will be lesser, which is a nice thing, okay? And then we can also just say the opposite thing. Let's just write it, for reference. Cost of goods sold will be higher. All right. In this case, what happened? Year 31st December 2007, he overvalued his closing inventory by $50. Closing inventory is higher, his cost of goods sold is lesser by $50, right? What happens when your cost of goods sold is less? One second. 2007, overvalued his closing inventory. This is chapter 10, and then we're going to start chapter 11 after we finish this, because last class we didn't finish this. But wait, am I doing something wrong? Opening inventory plus purchase minus closing inventory, okay. And then the higher your closing inventory, the lower your cost of sales. Okay. So then why is it saying this? Alright. Our cost of goods sold are lowered, meaning our gross profit will be higher. Okay. Very simple. Because if your cost of goods sold is lower, say you have sales, to calculate gross profit, what do we do? Sales minus cost of goods sold equals to gross profit. Say my sales is 100, my cost of goods sold is 50, my gross profit will be 50. Okay, but due to this, my cost of goods sold decreases. Like due to this error, my cost of goods sold decreased, right? So if I take 100 minus 30 equals to 70. So you can see my gross profit is overstated. It's supposed to be 50, but it is 70. So that's exactly what they're showing over here. Now, this is 2007, the year in which he made the mistake, okay? And in this year, 31st December, like he overvalued his closing inventory. So the next year, this closing inventory becomes the opening inventory at like 1st Jan 2008, okay? It becomes the opening inventory, this same value, this. So like if you overvalue your closing inventory, you're also overvaluing your opening inventory for the next year. And if our opening inventory for the next year is overvalued, then our cost of goods sold will be increasing. So, for closing inventory, there was a minus sign. So, of course, it was decreasing the cost of sales. But here, there is no minus sign, it's a plus sign. There is no negative. So, the higher your opening inventory, the more your cost of sales. Okay. So, if opening inventory is overstated, then your cost of goods sold will also be overstated. Okay, they're directly proportional. And in this case, that's exactly what happened. Our opening inventory was overstated, our cost of goods sold was overstated. And if cost of goods sold is higher, then your gross profit will be lower. Cost of goods sold is overstated, so gross profit is understated. Okay. And then, profit, gross profit, and profit for the year are directly related. So, like 2007, if this is overstated, then this will also be overstated. Same thing here. If this is understated, then this will also be understated. You can see it. Very simple. Now we come to capital at 31st December 2007. The profit at 2007 was overstated, so the capital will also be overstated. Why is that? How do we calculate? Wow. Okay, wow. All right. How do we calculate closing capital? Did we discuss this yet? Yeah, we did. I'm pretty sure we did. We didn't clearly discuss it like in terms of a formula, but when making the balance sheet, we did it. So it's basically the capital account thingy. Say this is my capital account. All right. At the start, what do we have? We have our balance BD, which is our total capital to the business, say 90,000. And then on the left side, we have our drawings on the debit side, say 10,000. Okay, wow. Okay, 10,000. And any additional capital, say I added money into the business, bank 10,000. Okay, and profit for the year as well. So if I make a profit of 10,000 again, now what do? We just balance it. CD is gonna be 100,000, and then we total it 110,000 and 110,000, and then we bring it down 110,000. Where is the closing capital in this? This is the opening capital. I think I'll change the color. All right, you see this is the opening capital and this is the closing capital. Okay, so our closing capital is 100K, and let's just, instead of making a T account every time, we can do it using a formula as well. So you can write closing capital is equals to opening capital plus anything that increases the capital, because if you're calculating capital at the start of the year you have 90,000. Now these both will increase your capital, so you have to add them to your capital, right? Very much common sense, you can say. So you do additional capital, and this is right, add capital, and then you add profit for the year because that also increases your capital, and then you subtract drawings because that decreases your capital. Where's this code? Yeah, okay, thanks for tapping that. All right, so you have this formula. Now if we just put it into action to see if it works or not, 90,000 plus 10,000 additional capital in form of bank plus profit for the year 10,000, and then subtract drawings 10,000. So we get again 90 plus 10, 100,000 is our closing capital. These both cancel out. All right, so you can see that the higher your profit, the higher your closing capital at 31st December, and that's why if this is overstated, this is also overstated. So like if your profit at 31st December is overstated, then your capital at 31st December 2007 both are overstated. And now capital at 2008, no effect. Why? Let's find out why. You see profit for the year ending 31st December 2008, it's understated. Why is it understated? Because gross profit was understated. And why was gross profit understated? Because opening inventory was overstated. Okay, opening inventory overstated, cost of goods sold overstated, gross profit understated, profit for the year understated. Why is there no effect on capital? Overstating. Okay, understated. What's going on? December will have been corrected. Huh? Understating the profit means. Yeah, but they didn't mention that we're correcting the error. Wait, stop here. Can you tell me why this is no effect? Capital at 31st December 2008. They're saying over here that saying this doesn't make sense, no? I thought they asked us in the question to like complete the following table pressing a tape to show the effect, right? Okay. They didn't mention anywhere that they're correcting the error. But here they're saying that cap the balance will have been corrected at 31st December 2008. She gone, bro. Okay, what is gone? Hmm. Let's think this through. Hmm. They're saying that if a profit is understated 1 year, then it won't have an effect next year. And that does make some sense. Like we overstated our profit. Oh, I'm stupid, guy. Anyway, I'll explain. They basically cancel out, alright? So you see how the profit at 31st December 2007 was overstated, and then the profit at 31st December 2008 was understated. So the capital at this year, sure, it's overstated. Next year, it's understated, right? Now when they both overstate and understate, it becomes normal again. Like it cancels out, right? So the error which happened previously, this error gets cancelled out in your capital. Yeah, why do they cancel? Because first the profit was overstated. Say instead of 100,000, our profit became, where is it? Our profit became 11,000, and now our total, our, what is it? Our closing capital became uh, oh, 101,000. Okay. Next year, what happens? Our profit is understated by 1,000. So let's just say our profit becomes 9,000. Everything else remains the same. So our capital will again become 100,000, right? That just makes it correct. Okay. So that's why there is no effect. But there will be effect on the first year because, of course, a problem happened in the first year. Then second year, this happened, but then the effect of that was no effect. Like, the error cancelled out. Okay. And then current assets. Again, the same thing is happening. That's why there's no effect. The first year at 2007, since you overvalued your closing inventory, your current assets are also overvalued since closing inventory is a current asset, right? Because its value changes multiple times during the year, so it's a current asset and it's overstated. If it's overstated in the first year, next year it's understated because, wait a second. Next year it will have no effect because it will be the opening inventory for next year, okay? This, at this date, 2007, it was closing inventory. And at 1 Jan 2008, it became opening inventory. Now, say this is $250 and they overvalued it and they made it $300. This is the inventory, opening inventory at the start of the year. At the end of the year, will it be the same? No, it can be more, it can be less. Say that the closing inventory is 400. In our balance sheet, in our statement of financial position, we only put the closing inventory. Okay? And that's why it will have no effect on the current assets for the year, for the next year, because this is opening inventory, it will have no effect on the closing inventory, of course. They're not related. All right. Does that make sense? So that's why this is overstated because clearly said 2007 overstated, and this one has no effect because this is for closing inventory 2008. So like the inventory at 31st December 2008 will determine whether this is understated or overstated, or you know. You you took all that time to type that? Yeah, exactly. So you have to be very careful about this kind of stupid stuff, and also about this kind of stuff. Okay. 1 minute. All right. Now we're gonna start chapter 11. Okay, I have a question, guys. Should I explain this chapter using the textbook the way I did all of the other chapters, or should I explain it on a blank paper? Like, I open a blank note and then I explain each thing individually. This is, you can say, like, many people find this chapter hard, but it's very simple. So I'm just asking if it's better to teach on a blank screen or if it's better to teach with the book. Okay, but can you give an opinion, a suggestion on what we should do right now? I'm okay with doing both. I guess I'll just continue teaching with the book then. All right, so this is other payables and other receivables. We're gonna, learn about matching costs and revenues. What was matching costs and revenues? This was basically the matching principle, which was, matching costs against the same year the revenue was earned and that kind of stuff. So even when we were discussing matching principles, I told that it has something to do with this chapter, a lot to do with this chapter, in fact. So today we're going to see what it has to do and we're going to understand it. Then prepare ledger accounts to record accrued and prepaid expenses, accrued and prepaid incomes, and then make adjustment for prepaid and accrued and prepaid expenses and incomes. Okay. So in short, this chapter is basically everything about accrued and prepaid, and this is also accrued and prepaid because the next name for matching principle, the other name for matching principle is accruals principle. Whiteboard. Okay, then give me a minute. I'll get the textbook, like the hard copy textbook. Okay, chapter 11. All right, now let's switch to whiteboard. Okay, I think I made this line. Where do we do that again? Okay. All right, that should do it. Can I delete this page? Mm, how do I delete a page? Okay, that's very cool. All right, now we're gonna start. Let me just write the heading, chapter 11, accruals and prepayments. All right. Now, what exactly do we have in this chapter? We're gonna start with, to learn how to make year-end adjustments, and we're also gonna like read why do we need to make year-end adjustments. Year-end adjustments is basically stuff which is accrued and prepaid stuff. And if you do not make them, then you're going to overstate or understate your profit and loss and all of that stuff. And then your current assets and current liabilities will also be overstated and understated. That's why you need to, apply the matching principle in this to make sure your profits and losses stay in the right place. Okay. Now, previously, when we made all our income statements and everything, we assumed that every single thing. Sudo for 14 second. Now, normally, if you're like in the previous chapters, in from chapter 1 to chapter 10, we were using income statements and balance sheets, but we had nothing to do with accrued and prepaid because we were assuming that all the amounts received and all the amounts paid were completely relating to the year. But that's not always the case. That's actually really the case because most people they either pay late or they either pay early. So it can be a prepaying, like they're paying early. Let's just say I have an electricity expense. It can be that I paid the electricity expense for the next month in advance, or it can also be that I didn't pay the electricity or the rent for the last month. Okay, so you are owing the expense or you have already prepaid it, and the same thing can also happen for your incomes. Okay, and you need to adjust this into your income statement to make sure that the things that are related to the other years are being removed, so you subtract them, and anything that is being related, like that's related to this year. Say I received a payment for rent last year but it's related to this year, so the rent payment was for this year but I received it last year, so you can also put that in your income statement. Okay, and we're going to have to adjust for that. That is adjusting for accruals and prepayments. Okay, so only items relating to that particular period that particular time period. Say if I'm making the income statement for 31st December 2024. So anything, any expense, any income that's related to this year, 31st from like 1 January to 31st December, you're gonna put it in this income statement. And anything that's not related, we'll subtract it. We'll like remove it. Okay, we'll adjust for it. Now, this entire thing, this adjustment is the matching principle. And even when explaining the matching principle, I told you guys about this. It's kind of a review, you can say. Yeah, but you might mix this up because you're not even sure right now. You're saying I think. So I'll also give a method, I used to use. and I still do use to, not mess up this kind of stuff. All right. All right, so accrued expense and prepaid expense. Let's just look at the definitions now. 1 second. I'll just straight up copy the definitions from the textbook. I won't even write them down, I guess. Accrued expense is expense relating to particular accounting period which is unpaid at the end of the period. Say this is my electricity expense, or rent. Electricity is a wrong word, long word. This is my rent, okay, and say it's 1,000 per year, okay. I, like the person who's supposed to pay rent, the tenant, I think that's what they call it, did not pay rent for the last year, okay. He didn't pay rent for the last year means it's relating to a particular accounting period, which is the last year's accounting period, and it's unpaid at the end of that period. It's not he didn't pay it even at that period, but we still record this in the income statement. So this was relating to year ended 2023, and he did not pay it even at the year end, okay. So like the whole year passed, he was supposed to pay the rent but he didn't pay it. Let's just say he was supposed to pay it at the start of the year but he didn't pay it. He didn't even pay it till the end of the year. So this is accrued expense, like we are yet to receive money from this guy, okay. Sorry, this is accrued expense. We are yet to give money to this guy, okay. So we're basically owing money to him. It's a current liability, okay. Next thing, oh, 1 second, they have a lot of information here in the book. When an expense is accrued, it means that some benefit or service has been received during the accounting period but has not been paid for by the end of the period. This rent, we already used it, like we were using the building or the premises or the room for the year, but we didn't pay for it. Okay, that's accrued expense. The matching principle basically states that you put this 1,000 into the income statement for this year. Even though we didn't pay it, you still have to put it. Why? Because it's an expense relating to this year. All right. And then the expense account, you will also do that. You'll also adjust for it in the expense account. You will write balance BD, balance AD, all of that stuff. Okay, now they're just in the book. They're just doing just making the T account, but I think I'll not use the book and I'll make it myself. Not sure balance equal to the amount paid. Okay. All right. Let me just, I'm just looking at the book to see till what exactly they're doing, and then I'll explain the year end. Okay. Okay. And then they have a nice example. All right. So let's just look at the format. It can probably be $100,000 per year for a small office room or something. It doesn't have to be a building. Mm, yes, exactly. It's pretty much like your trade receivables. They are also an asset, but you didn't receive them yet. It's money you will receive. A prepaid income is the service you will receive instead of the money. Okay, now let's have a look at expense accounts. Come on. Why is the line not over? Okay, so let's just say this is our rent account. All right. Now you guys know this is the debit side, this is the credit side. The way I like to remember it is, assets come on the debit side and liabilities come on the credit side. Everybody knows that. No, pen is chill. Assets come on the debit side, liabilities come on the credit side. Now let's have a look at which ones are assets and which ones are liabilities. So we have two things, right? We have accrued and we have prepaid. This is accrued expense. We have accrued expense and we have prepaid expense. The same thing is also there for income. We have accrued income and prepaid income. But for now, let's just understand expense account first. Income account is pretty much the same thing. All right. Now, accrued expense is that you still have the expense owing at the end of the year. It relates to the particular accounting period and it was unpaid during that period, meaning you didn't pay the expense. You were supposed to pay it, but you didn't. You're not a nice person. So this is a current liability because you have to pay it. If not today, if not this year, maybe next year, but you still have to pay it. It's an amount you owe to your, you know, the guy who's giving the service. That was not expected. Okay. And then prepaid expense is when you pay the expense in advance. So if I'm let's just say in 2023 I pay for electricity bills up to 2025, so I basically paid in advance for 2 years, right? But this doesn't mean that I'll record all these 2 years in the income statement for 2023. I'll record it in the income statement for 2023, 2024, 2025. I'll record the same amount for each year, like the respective amount for each year, you can say, I guess. And then that means that this is a current asset. Why is it a current asset? Because you already paid for the expense. Now you will receive the service. You will receive the service. You own the service. Okay. Like the person giving the service owes the service to you. You are to receive the service. That's why it's an asset. And then here you have to pay. That's why it's a liability. So you can just say owe money to whoever's giving the service. Okay. And that's what's a liability. So now we know which one is a liability and which one is an asset. Okay. So expenses, both balance, prepaid debit, accrued credit, income statement. I don't know what you're trying to say, but whatever. We'll understand it eventually. So right now, I just said that assets come on the debit side, liabilities come on the credit side. Prepaid expense is an asset, so you're gonna write here. Instead of writing prepaid expense, we will write balance BD because this is the first. Okay, it can be a prepaid. If it's a prepaid balance BD, it's gonna come on the debit side. Meanwhile, if it's an accrued balance BD, it's gonna come on the credit side. Why? Because accrued is a liability and prepaid is an asset. Okay. And then the amount can be anything. Now, why is it balance BD? Because it's going to be on the first date. So, of course, when you make an account, this is, let's just say, 1st January 2024. Okay, 1st January 2024. I think I'll make it smaller. And then this is also the same date. You need to write dates. There is one mark for the dates 2024. Okay. Here, let's just take this example. At 2023, you paid for the expense, and that's why 2025 it's a balance BD. It's not. Wait one second. I'll see what the textbook has to say for this, because I don't really know what to say for this. To be honest, they not have balance BD. Balance BD. Telephone expense to the credit balance. Oh well, they're not giving any reason. They're just saying that it starts with credit balance. Oh wait, I don't know this. Yeah, they're straight up saying had a debit balance. So when you balance the account when you balance your T accounts, you do this CD stuff. So let's just say CD 150 here is gonna become BD 150 for the next year, right? If you We'll discuss this as we go in the example. It will all make sense. All right. So this is it for like the accrued and prepaid. Okay, balance BD for prepaid comes on the debit side because prepaid expense, this is a rent account, it's an expense, comes on the debit side, and then accrued balance BD for accrued comes on the credit side. Now, your rent account or your expense account is not just limited to this, right? There's also you paying your expense. What is the journal entry when you pay your expense? What do you do? If you're paying expenses, say you're paying with your bank, so your bank balance reduces, right? And bank is an asset. uh, we have understood bank using this plus minus signs. When we reduce our bank balance, we record it on the credit side, and when we increase, we record it on the debit side. Right now, when you pay your expenses, your bank balance reduces. So in your bank account, you're gonna have to write rent, let's just say whatever amount, and this means that in your rent account, you're gonna write bank on the debit side. So rent account is debited and bank account is credited. This is when you're paying rent by bank. All right. So what do we do in the rent account? We record bank, we write bank on the debit side. This means that the rent account is being debited. This is you paying the rent, okay? You don't need to write this in brackets. I think if you write it, you might even lose marks because they're just very bad at checking. I'm just writing it for our understanding, okay? Now you wrote this and you wrote this. One more thing you have is your accrued and prepaid at the year end. Okay, you know how we had it at the start of the year, you can also have it at the end of the year, right? It's just that both things don't happen at once. It's either rent prepaid or it's either accrued, but I'm writing it for the formula. So instead of writing rent account, I should probably write here expense account. to like help understand better, I guess. And then here you can just write paying the expense. Okay. Now our next thing that happens is balance BD, balance CD. And to do that, instead of like memorizing all the crazy stuff, you just understand the same concept again, that liability will come on the credit side. What is a liability? Balance BD accrued. Expense accrued is a liability. So you can simply write here BD accrued, because it's a liability, it will always come on the credit side, right? The balance BD of the liability will always come on the credit side. This will be 1 January 2025, okay, because it's the next year. If the BD is here, second, oh dear, we'll make this go one line down. Wow. All right. And then the same thing happens on the other side. We're gonna have prepaid balance BD, but on the next date, balance BD, and then this will be prepaid, and again 2025 January 1st. Now tell me, where will balance CD come? If balance BD for prepaid is on the debit side, then it's pretty much common sense that balance CD will come on the credit side, right? So you can just write balance CD. By the way, in the exam, you need to write it completely. You need to write balance, and CD is allowed, BD is also allowed. And in the brackets, you don't need to write prepaid. If you write it, you just look cool. You don't even look cool, probably you look stupid. But I'm just writing it for our understanding. It's my habit as well to write it for my own understanding as well. So if balance BD is on the debit side, why is balance BD on the debit side? Because it's an asset. If balance BD is on the debit, balance CD will be on the credit. This basically means that, what if I just clean all of this? Oh wait, what if I just put this down? I'm a genius. All right. So, if this is balance PD on 31st January, on 1st January to 2024, it means that on this side, like if you go last year's expense account, then on the credit side, you will have the same balance, the prepaid, as CD, right? Because, we all know how the accounts are balanced. We already studied that, balance CD accounts. So the same thing is applying here. When you have a PD on the debit side, you're going to have the CD on the credit side. And the same thing over here, CD accrued will also come on the credit side. So you're going to have balance CD accrued. This will be the closing date, 31st December, 31st December. And this bank can be any date. This bank is showing that you paid the expense. Okay, now you can pay the expense anytime during the, you can pay it 30 December, you can pay it 31st December, you can pay it 1st January. It's up to you, because it's your choice whenever you want to pay the expense. Now after all of this is done, you can see that it will not be, I'm making the lines wrong. Tuck, 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 Now, if you make an account like this, like say you have an actual expense account, you will see that it will not total. This total and this total will not agree. There is something missing. This total will be greater because you paid by the bank. Over on here, on this side, you're going to write income statement. And this will be your year-end transfer. We studied earlier as well that we have to transfer all the expenses to the income statement. And that's why we credit the expense account and we debit the income statement. And when studying income statement, we also studied that the income statement has a T account format. So if this is our income statement, this is our debit side, this is our credit side. Anything that increases the profit or increases the profit comes on the credit side. So like sales and your incomes come on this side, and then all your cost of goods sold and expenses come on this side. Okay, and profit for the year comes on this side as a balancing figure, meaning like this side is greater. If this side is 1000 and this side is 900, then 100 will be your profit and it will now be equal to 1000. Okay, and of course if this side is greater, meaning if your expenses and cost of goods sold are greater, then you're making a loss, and that's why it's going to be showing on this side. Okay, now as far as this is concerned, we know that income statement is debited with expenses, meaning expense account will be credited with income statement. Okay, does that make sense to everybody? Now your account will balance. How do you know what is the value for income statement? You're basically gonna make this all account, you're gonna have, let's just say, 2000 here, and if you have 1800 here, then income statement will be 200. Okay, so it's gonna be balancing figure. You need to make both of the sides equal. You need to make them total, and income statement will be the balancing figure. All right. And if it's like only one expense, like if it's only rent or only insurance or only something, then you won't have two balance for downs. You will only have one. We'll also do an example for this, I think, because like it's an important chapter, you can say. Now, to confirm your answer, say you don't like making T accounts, or say it's a small MCQ and you don't really want to make such a big account for it. You can also, understand it, but making the T account is always the safer option. So I want you guys to answer this. 1 minute. Okay, okay, okay. Expense both balance. What do you mean both balance? Prepaid debit, yes. Accrued credit, yes, because it's a liability. Income statement will always come on the credit side for an expense account. Why will it come on the credit side? You also need to know the reason. So when you're teaching someone, it's going to be easy. Or when you forget the format yourself, you can, always come back to it because you understood the concept. So if you understand the concept, that's one benefit. Because income statement, when we debit it with expenses, so we debit income statement with expenses, and that's why we credit the expense account with income statement. Okay, so it's just going to be something like this: debit income statement, credit expense account. Yes, exactly. Like before my CIE, I taught the entire syllabus speed run, and it was like a 4-hour session, and that was my method of revising as well. Was good game. All right, payments always debit. Yes, payments come on the debit side of the expense account. Why is that? We already discussed. Where is it? We already discussed because of your bank account. If you're crediting your bank, you have to debit your rent account because you don't have an entry. If credit the giver, debit the receiver. Bank is giving the money to rent account. Rent account is receiving the money from bank. Okay. All right. I'm just saying the way I understood it in exams. With other I don't know if anybody teaches econ like me, but IGCSE online on YouTube teaches econ nicely. I haven't seen all of his videos, but I like his teaching style, you can say. And he apps like me, so that's kind of cool. It's rare to find somebody like that. But he apps nice. I just yap. Like I barely know what I'm saying most of the time. Okay, now that's for expense account. Let me just see the textbook till where we have reached. Mm. Oh, by the way, you guys all understand all of this, right? I think like after this, I'm gonna after this. Oh wait, I can click the rep 1 second. That's super cool. After explaining with this, I think I'll shift to the textbook and just explain. Like we just have a quick go through. So this was the definition of accrued expense. I already read it from the textbook. Then matching principal amount transferred to the income statement should represent the expense only for that year, okay, only for the accounting period covered by that account. So like if it's 2024, then the expense should only be for 2024. Any amount due but unpaid at the end of the financial year must be added to the amount paid. What does this mean? Say I have like my rent account. Oh wait, we can just use the terminology we learned. Any amount due but unpaid means that you owe someone the expense, like you have not paid it yet. That's accrued expense. Now tell me which side does the accrued expense come? Comes on the credit side, must be added to the amount paid and the total expense. Is this is a joke. Will not show a balance equal to the amount unpaid or whatever. We can just look at the account directly. So this is their account, okay? They have cash 44, total expenses paid in cash. So credit cash, debit the account, expense account. Then paid by credit transfer 56. So bank credit and expense account debit. Then again paid by credit transfer 62. Bank credit, expense account debit. You can see expense account is being credited. And I'm pretty sure they even showed us a bank account. They didn't. Okay. So we can just make our bank account ourselves, say this is your bank account. Everything's gonna come on the credit side like 44, 56, and 62. Okay. Now, one second. I guess nothing can be done about it. What's capitalist? I told you how is thank you. That's a compliment. Mm, what's the capitalist? Okay, anyway, I'm sorry if you're hearing any background noise, but nothing we can do about it. It's my mother. Alright, invoice for telephone expenses 59. Okay, this is the fun part. This is, all the common sense. Anybody can do it. Like it's just credit, debit, debiting your expense account, crediting your bank account. But this is the whole point of this chapter. So invoice for telephone expense was received. This is our expense. We have to pay it. We received an invoice. Like, let's just call him supplier or the person giving the service tells us, yo, it's time you pay your money. And, he gives an invoice to show that. For 59, received on 31st March 2008. Now, for this kind of questions, you need to know when the year ends. 1st April 2007 is when the year starts. 31st March 2008 is when the year ends. Okay. So this is year end. This was for telephone expenses up to the end of March, but was not paid until 5 April. That's kind of weird way to word this stuff. Telephone expenses up to the end of March, so you can see that they paid the telephone expenses all the way to January. They didn't mention it. That's crazy. April, May, June. Oh, what? That's crazy. December, January, February, March. And then this is 3 January paid by 62. 44 plus 56 plus 62 is 162. So they paid 162 is paid. And you can see on the timeline here, the year starts at 1 April 2007. So this is 1 April 2007. And then we paid all the way till here. Though this doesn't make sense. They should have stated it more clearly. Uh, oh, okay, my bad. It's written here. Invoice for telephone expenses quarterly in arrears, meaning like arrears mean owing, accrued, same thing. During the year ended, his payments included the following, meaning that this 30 June is for April, May, June. Okay, his year starts in April. Quarterly means like a year has 12 months, and make it into four is 3 months each quarter. So this is for 3 months. This is for 3 months. This is for 3 months. He paid April, May, June 44, July, August, September 56, October, November, December 62. Okay, now you can see that the dates he paid on October, but he paid up to September, and here he paid on January, but he paid up to December, and here he paid on 5th April, but he paid up to March. Okay, oh sorry, he did not pay, but it's up to March. So from December, we paid all the way till December from April. And now we have January, February, March. These 3 months left, and it's 59. We did not pay this yet. What is this? It's an accrued liability, accrued expense, and that's a liability. So let's just see which side it comes. We have 59 BD. Always look at the BD, because if you start looking at the CD and you're remembering it using the debit asset and credit liability method, you're gonna mess up. Okay, so instead of looking at CD, you have to look at the balance brought down instead. This is a liability, and that's why it's credited 59. And you can see, like, it's pretty much common sense. If the BD is on the credit side, then the CD will be on the debit side. Okay, 59. Now you balance the account, and again, it's pretty simple. They probably said something about it. Whatever. So instead of, like you already wrote CD and BD, what are you going to do? You're going to write CD here again, but that just means that you're going to carry the expense to the next year, but you already paid all of this. Say you wrote here 221 CD, and then you wrote here BD 221. This would mean that your current expense, your prepaid expense in fact is 221, but that doesn't make sense because you already took the service and you already paid the money. So that's why you have to close the account, and instead of writing balance CD, balance BD, you're going to transfer the year's expense to the income statement. We already discussed this, and that's going to be the balancing figure, meaning the total of this plus the minus the total of this will be the income statement, and here the total is 0, so 221 minus 0 is 221. All right, and then in the income statement, in your expenses, you will write telephone expenses 221 instead of writing, this much. This is 162. Instead of writing 162, we paid only 162. We did not pay 59, but we still write it in the income statement because it relates to this year. And then in your current liabilities, since this 59 is a current liability, you're going to write it over here. And you can write accrued expense or you can write accrued telephone expense, but the best way is to write other payables. So if you have multiple accrued expenses, so let's just say this 59 plus 100 plus 90, all of that will come under other payables, okay? And it's going to be a current liability. And they can say when there's several accrued expenses, it's usual to show one combined figure under other payables rather than showing the amount of each separate accrual. Now, prepaid expense, man, am I going too slow or should I go fast? Like, should I go faster? Because it's already been 46 minutes and we have quite a lot left. We have to do income accounts as well. Prepaid income, accrued income, combined expense accounts. Oh, they did mention opening balance on expense accounts. The trader mentioned was his first year in business, so now none of the expense account was prepared in this example had an opening balance. Okay, that makes sense. The examples we were doing before, I was looking for an opening balance, but since it was his first year of business, they didn't say anything about opening balance. But of course, there was a closing balance, which became the opening balance for the next year. So yeah, they didn't say anything about it again, but they just said that opening balances do exist. Where do they come from? They just come from the previous year, bro. Like, normally they do. Anyways, even the book likes to, yeah. Yeah, because like when I explained accrued expenses, you all understood it properly, right? If you understand that, then prepaid expenses is same thing. In fact, we already did it. Prepaid expense is the expense paid, but it's not for this period. So say my year is ending 2024, 31st December, and I paid rent for 2025 all the way up to 2025. So that is prepaid expense, okay? Okay, so if you guys understood it, then that's perfect. I'm pretty sure the people on YouTube will understand it as well, I hope. Mm, Paid in advance. Prepaid means that the payment has been made during the financial year, but the service or benefit will be received in a future accounting period, meaning not in this financial year. It's gonna be for the next year. Okay. The same example, like I paid rent in 2023, but I paid it for 2025. Now, same thing as accrued expenses, you need to apply matching principle, and any amount paid during the financial year. This we don't really like. You don't need to understand this, but you need to understand it as well. Like it's good if you do, but if you have the account, the format, if you understand the format, then this is just the same thing. Let's just read it anyway. Any amount paid during the financial year relating to a future accounting period must be deducted from the amount paid, so that only the expense relating to the accounting period is transferred to the income statement. Okay, this basically means that during my year, I paid 200,000 for rent. Okay, but my yearly rent is only 100,000. I paid the rent for next year as well. So I'll subtract this 100,000 and now I have 100,000 over here. How will I subtract this? You're going to do it like this. This is your rent account. This is your bank, 200,000. Instead of writing here 200,000 minus 100,000, you won't do this stupidity. You're a good accounting student. You're going to write over here CD and you're going to write prepaid rent, yeah. And it's going to be 100,000. What's going to happen? It's automatically going to subtract, and next year you will also have BD paid 100,000. Okay, so you don't subtract it over here. When you make an account, you put it on the other side and that will automatically subtract it, right? But if you're not making a T account, then sure, subtracting this is, you need to do that. Any amount paid, okay, okay, okay. Expense account will not show a balance equal to the amount paid in advance. Then the balance is brought down, balance is brought down. As the balance represents a short-term benefit, it will be included as a current asset. So you can see, since it's a current asset, it's being debited. This prepaid rent is a current asset, and that's why it's going to be debited. And it's also going to be shown as a current asset in the statement of financial position, which is your balance sheet. And it will not come in the income statement because you already adjusted everything for the income statement. Like, you get the final amount of the income statement through this. Now the entries are summarized. Debit the expense account, credit the cash book, because whenever you pay, you credit your bank, you debit your expense. Then credit the expense account with any amount paid in advance. This is the amount we paid in advance. Carry down as a debit balance. So this is carried down and then you bring it down as a debit balance. Okay. Then you have credit the expense account and debit the income statement. So this is our expense account, credit the expense account and income statement, meaning that on the debit side of the income statement, you have your expense, which is going to be rent. This is why I kind of don't like the book. It's making stuff so much more complicated for no use. But it's helpful. Like, it has information. Credit the expense account and debit the income statement with the difference on the expense account. Credit the wait, what? Oh yeah, okay. Okay, we already read this. This is credit the expense account and debit the income statement. Include the balance of the expense account as a current asset in this statement of financial position, sure. And then they're just giving us an example of prepaid expenses. You can see that this is prepaid. How do you know if it's prepaid? Because the balance BD is coming on the debit side, and the debit side represents like assets come on the debit side, and that's how you know that this is prepaid. Okay, okay. Then in your income statement, you're gonna have the expense 450. This is after making the adjustments, and in your balance sheet, you're gonna have other receivables. Before it was other payables, which was a liability, and other receivables is a current asset. This is 150 is your prepaid expense. Okay. Uh, what? Purchase stationery, inventory of stationery. Wow, this is crazy. Oh, bro. Okay, stationery account is an expense account. Okay, do not think that this is an asset account because we studied the materiality principle that cheap stuff we don't really make individual accounts for them. We just count them as an expense account. They're not treated as an asset. They're just treated as an expense. Okay, since it's cheap stuff, since it's like what 36, what do we do with that? We talk in $1 million. Okay, this account new because there's no balance. Yes, exactly. Meaning like it's the first time of the business. Okay, or it's the first time he's buying stationery. All right, there can be two cases. Either way, there will be no balance BD. Okay, so what's happening here? You pay for the expense, same thing. Then you write income statement on the credit side, same thing. This is gonna be your prepaid. Why is it prepaid? Because like you paid for the expense, but you didn't use it. Okay, you paid for the stationery, but you didn't use it. That's what prepaid expense is, right? Prepaid expenses that you paid for the service, but you didn't use it. Here you paid for the stationery, but you didn't use it, so you're just gonna bring it down, and this will be prepaid, and this will also be shown as a current asset. So instead of thinking of stationery as an expense, simply think of it as an sorry. Instead of thinking of it as an asset, simply think of it as an expense, and that way everything will just, what do you call it, like, connect. Yeah. Now opening balances and expense accounts, they just come when there's a closing balance. Closing balance can be when you have a prepaid expense or an accrued expense, and that way you will just have a closing balance. In case you do not have any prepaid or accrued, then your account will close over here like tuck 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 tuck, but that's pretty rare. Like, it means that you paid only the amount relating to that year. It happens, of course, but not always. At least not in IGCSE questions where they want to bully you the most, like as much as possible. Hmm, okay. Then they're showing that, they're telling about opening balances. So opening balances is very, very easy. They literally just say it straight up. Credit balance of 59, meaning that on the credit side you need to show 59. That's it. You don't get a mark for this. I think you don't get a mark for this, but the easiest possible thing. And then here is similar thing as the previous question. This again quarterly, meaning that the year starts at 1st April. So this is for when he does prepaid quarterly arrears 59 59. All right. Now look at this example here. They said that it's in arrears, meaning like after using the service he pays. Okay. And we have our first example here, $59 at 1st April. Why is this 59 balance BD and what does this mean? This means that it's accrued expense. Okay. It's accrued, it's 59, it's coming balance BD. How do we know if it's on the credit side? The question straight up told us. And now on 5 April we pay 59. 5 April we pay 59. Okay. This cancels out. That's the point of writing it on the credit side. If you're not making the T account, then you're gonna have to do something like this. This is relating to the previous year. Okay. Wait a second. You just take this is relating to the previous year. Uh, wait, I'll tell you how I do this stuff, okay? So you take the amount paid, total bank, let's just write amount paid, okay? You subtract anything that's previous year or next year, meaning it's not related to this year, of course, and you add anything that is related to this year, but it was paid at any other date, okay? It was paid earlier, it was paid in advance. Now let's look at what exactly I mean. Paid in cash 59, paid by check 60, 48, 56, and not paid. Okay, so we just take our calculator. 59 plus 60 plus 48 plus 56. Okay, you get 223. All right, so you just take 223. I'm just telling you how to do it without making a T account, okay? But we need to like nicely understand the concepts to do this stuff. Now this 59 is related to the previous year. How do I know if it's related to the previous year? It says that quarterly in arrears, and it also says that it's a credit balance, meaning that it's a current liability, it's accrued expense, and that's why it's related to the previous year. So you can subtract 59, and here also it's showing that they paid it, but it's not for this year. It's for the last 3 months. It's short. They probably show it in the timeline. Uh, yeah, this 59 we paid is for January, February, March of the previous year. Okay. And then this is for our year. This is the year we're making the income statement or the expense account for. This is for 2008. And that's why you first subtract this because it's not related to this year, it's for the next year. And then you add the 63 because it is related to this year. This was for the telephone expenses up to the end of March, meaning up till here. So this 3 months, we did not pay it, 63 owing. But since it's related to this year, we have to add it. So we do plus 63, okay? So you do minus 59 and plus 63 and you get 227. Now if you look at the example in the question here, 227. So you got the correct answer without having to struggle so much and make all the accounts, okay? But how did you get it? You had a clear understanding of the concept. If you are doing it this way and you don't understand anything that's happening, then you make a T account because it's easier to understand, and you can understand it better, and it's way safer because you won't be making silly mistakes. Now, what do they have here? A debit balance of 150, something similar probably. This is a debit balance, it's an expense account, meaning that this is prepaid expense. Paid 1 year's insurance by bank on 1st July. So we have 1st July, bank 636. Write up the account for the year 31st March 2009. It may be helpful to consider I use a diagram. Showed a debit balance of 150. Now look, this debit balance of 150 means that prepaid prepaid 150. Okay, and this 636 for 1 year means that 636 is for 12 months. 1 month is how much? You just calculate that. Probably 636 divide by 12 and you get 53. Now you have to be careful about the dates. Okay, we paid 150 last year, it was relating to this year. Okay, and we paid 636 this year. That means that we still have this much advance. Okay, it shows that expense paid do not match the period covered by the financial year, so it's necessary to deduct. Now, how do we know if it doesn't match, and how do we know, like, whatever is happening, how do we know what's happening? You see, on 1 July 2008, he paid for 1 year. So he paid all the way up to 1 July 2009, and you can see it over here. He paid up to 30 June 2009, which is like one day before 1 July 2009. Okay, he paid up to that date, and our year is ending on 31st March 2009. So he paid 3 months extra again, right? Does that make sense? So that's why, since he paid 3 months extra, we first have to calculate how much extra he paid. 53 times 3, because that's 3 months, and that's gonna be 159. 53 times 3. Okay, so you can see that this 159 is again our prepaid expense, and that's why it's coming on the debit side, because it's an asset. Okay, and then you just have, if you have the the balance brought down on the debit side, you're gonna have the balance carried down on the credit side, and income statement will be your balancing figure. This represents the total expense for the year ended 2009, sorry, 31st March 2009. Okay, and your income statement, you're gonna show it that way. That makes sense to everybody. I think I'll have to extend today's class to like 1.5 hours, because I want to cover this all quickly. Now, when you have, when I was explaining the accounts and I was doing it on the whiteboard on the blank paper, I was saying that you won't always have balance BD and balance CD both. But in some cases, people have the rent, like people have combined expense accounts. Okay, combined expense accounts is like one ledger, means one T account for two different but similar expenses. So you will still have a different balance BD, balance CD for them, but they're similar, and that's why you put them in a single account instead of making multiple accounts. Mm, Everything is similar. Okay, there's just that two opening and two closing balances. So let's just straight up look at the example. This is going to be prepaid. You can simply tell because it's the debit side. This will also be prepaid. This will be accrued. This will also be accrued. And this is all the amount we paid during the year. And this is the income statement, which is the amount relating to the year. And this is the last thing we do. Okay, like this is balancing figure. Balancing figure means that every single thing is done. You total this, you total this. Whatever the amount is left, for example, this side is going to be lesser. Whatever amount is left, you're going to record it over here. But how will you know how to total it? Say if this is 11,200 and this is going to be 10,200, and then 10,000, and then 9,600. What, 9,400, I guess. So oh wait, I'm so stupid. It's 9,600, okay? Now you don't know how much of that is rent and how much of that is rates. So you're gonna do it separately. How do you do it separately? You just take your rates 300, rates 3,900. So we have 300 plus 3,900, and then you subtract the opposite side. There is nothing about rates over here. There is this rates over here, minus 600, and you get the income statement figure for rates 3,600. Same thing you do for rent. Since I've explained this, I'll just clear it up. Okay, you do the same thing for rent. You count it separately, 4,000 plus 2500 plus 500 and then minus 1000, and that gets you 6000. Okay, so that's your income statement and that's how you do it. Now we are adding this 4000 because we take the amount paid, the formula thingy I told earlier, like you just take the amount we paid, add anything that's relating to the year, so like add anything that's for this year and subtract anything that's next or previous year. Okay, this we discussed was accrued. Accrued means that it's owing at this date, it's owing at 1st April 2008, meaning that it's something relating to previous months, right? It's not something relating to this year, it's something relating to previous months, but it's owing this month. So this is of course not part of this year, and that's why we subtract 1000. And this is prepaid. How do we know if it's, sorry, this is accrued and this is also accrued. But why are we adding this accrued? Because this is closing accrued, meaning at the end of the year, or if you just look at the opening accrued, if you look at the opening accrued for the next year, you can understand that this 500 relates to the previous year. Okay, it's owing at 1st April, but it doesn't relate to this year. It doesn't relate to 2009. It relates to the previous year. It relates to this year, and that's why you're gonna add it to the income statement of this year. Okay. Or another way to remember it is like, since it's closing accrued, is the amount you owe somebody at the end of the year, and it's relating to that year. Okay, so I hope that makes sense. But yeah, if it doesn't, you can always ask questions or take classes. Subscription account. Yes, exactly. Subscription account is also the same thing. If you understand income account, subscription account is literally copy paste. Okay. So you add 500, we just do 4000 plus 2500 plus 500 minus 1000, because this 1000 is for the previous year, and that way you get 6000. Okay, very simple. Now income is the same thing, literally the same thing. You have to debit assets and you have to credit liabilities. But there is one difference. This is such an easy example, I don't feel like doing it. This is also such an easy example, I don't feel like doing it. Okay, this looks nice. Alright, so we have our income account here. Debit side is assets and credit side is liabilities. When we were doing expenses, we discussed that it will be accrued expenses on the credit side. But when we're doing income accounts, it's different, right? How is it different? Accrued income means you will receive the money and you gave the service. Okay? If you are gonna receive the money in the future, it's the same as trade receivables, right? Like you gave them goods, but you will receive the money. So this is an asset, okay? Because you will receive the money, you own the money. And prepaid income is that you owe the service. So if my income account is rent receivable account, meaning that I have to give, like someone is coming to me and taking part of my office as rent, they already paid me the money and now I have to give them the service. I owe them the service, I owe them the rent. Like they will live in that place and they already paid for it, so that's why it's a prepaid income, and that is a current liability. So in this case, credit side liabilities, if it's anything, since it's an income account, this should be prepaid. And if there is any balance PD on the debit side, that will be accrued income, because accrued income is an asset and prepaid income is a liability. The bank side also switches places. Why does it switch places? When you receive money, since this is an income account, you're receiving the money, and the journal should be to debit your bank. Why do we debit our bank? Because we studied bank account and cash books like this. Anything that increases the bank balance will be debited. Why is it that way? Because bank is an asset and assets are debit positive, meaning every time you debit the asset account, your bank balance increases. Yes, exactly. What do you mean? If it's prepaid income, then you owe them the service, and that's why it's a liability. Okay, then bank is an asset. You're receiving the money. You're receiving, wow, you're receiving the money. So you debit bank and you credit the income account. Okay, because double entry. So this is us receiving money, and over here it's balance CD. We do not look at balance CD to judge whatever is happening. We can judge using this debit side asset balance BD. How do we, it's an income account, so accrued income is an asset. We know that this is accrued, this is also accrued, and now we just do income statement balancing figure. If this is accrued at the closing date, means that the guy or the tenant owes us this money. It's relating to this year, and that's why it's coming on this side. Okay, it's being added to the bank because it's relating to this year. And this one is also again prepaid, meaning they paid for it last year, but it's relating to this year. That's why it's coming on this side. Okay, prepaid income, it's a liability, it's coming on the credit side. Income statement is going to be our balancing figure. Income statement comes on the debit side. Why is that? Because we discussed that if you make a T account of the income statement, on the credit side you have anything that increases the profit, such as your sales or any other income. Okay, and rent receivable is part of your other incomes, and that's why if you credit your income statement, the double entry would be to debit your income account, credit your income statement. Okay, that makes sense. And yeah, that's the end of this chapter. uh, Now I have a challenge for all of you, and if people are watching the recording, then I'm being trolled. If people are watching the recording, then I would appreciate even if they try it, and then if there's any questions, one second. If there's any questions, you guys can just post it in the chat, I guess, in the accounting chat. Since we have like 20 minutes left till the, do I'll be going right now. Yeah, I'll just share this question and then I'll leave. What's this, bro? This is a joke. Maybe I can search it. It's wrong. Is my, oh wow, my internet. Oh, that's crazy. Did I get kicked out? Can you guys hear me? Can you guys hear me now? My internet suddenly disconnected. Oh well, anyway, I was saying that I was gonna give you a challenge, and let me show you the challenge. By the way, this is the hard accounting questions thread, and then I used to post hard accounting questions here. I'm forwarding it in the accounting chat. Okay, and thank you guys. Alright, you can start this, and then once you're done with it, you're gonna get absolutely cooked. But if you actually focus during the class, it wouldn't be that bad. I think one of you have already tried this. As for the people on YouTube, give me a minute and I'll open the picture. You guys can just pause the video and then watch it. But I'm just looking for any more annoying questions. Hmm. We have this as well. Okay, so this is one question. I will share this as well. Okay, and the other question is, yeah, yeah. I remember. So yeah, it's a really nice question. You know, you might feel like jumping from your roof or something after you look at this question, but please don't do it. Anyway, this is it. And once you're done with the question, you guys can just open the mark scheme. For that, you just go to Google and type this code over here, and then type MS instead of question paper, and you're gonna get it. All right, that's that. See you guys tomorrow. And oh yeah, I'm enjoying this literally. If you like it, then it's not. Look, just tell me how many marks you got. if you guys got more than, let me see how many marks it is. This one is 6 marks, right? If you guys got more than 3 marks, that's crazy achievement. And then for the income statement, I don't know how many marks it is. It might be, I can probably search it up. Summer 18, paper 22. 0, 4, 0, 4, what? 0452, summer 18, paper 22. Question paper. Mm, More than three. Yeah, but like if you guys get more than three, that's actually big achievement, okay? I haven't seen the mark scheme, but I'm just saying it. If you get more than three, congratulations. Oh, and this one is 12 marks. If you get more than six, congratulations. The income statement. Oh, wait, am I doing this correctly? Is depreciation, gross profit margin, credit terms. Wait a minute. Oh, I remember. I remember getting absolutely cooked by this question. It's not hard, okay? Yeah, there's nothing on this that you guys cannot do. For the depreciation, I haven't taught it yet, so I don't, if you get it wrong, it doesn't matter. But yeah, try these questions. The income statement is not really related to the topic we did today. But, if you want to try it, you can try it. I'm pretty sure I shared more of accrued and prepaid questions. I can't find them. Oh, this, yes, yes, yes. Okay, so this is our second question. First question was Eniola. Second question is this. All right, I'm forwarding it. The income statement is just a bonus. If you feel like doing it, you can do it. All right, all right, all right. I forgot your real name. I forgot. I mean, my real name is not easy to remember as well. Okay, but yeah, good luck with this. So you just have to do this one, and the people on YouTube, good luck. I'll make it easy for you all. I'll just find the income statement for this. Sorry, the mark scheme for this. Why am I saying income statement? Now to find the mark scheme, just search up the question. Sarah maintains a combined account for rates and insurance, and now you're gonna get this. 1 August 2017. It's already existing. This is probably like 8 marks or something. Wow, 3.5 MB and it's taking that long. Uh, 8 to 18, oh, it opened. Before part to enter 18 to 21. Mark scheme, sure. This perfect work for head and certain. You can cry all you want, you won't be able to do anything. Okay, this is 8 marks. Yes, I was correct. So for this, if you get 4 out of 8 is amazing. And for the Eniola, if you get 3 out of 6 is also amazing. Alright then, see you guys in the next class. You can compare your answers with the mark scheme. This is this is what year? Winter 18. April 23. Okay. And by any chance, if you feel like, this is not enough practice and you guys want to do more, then do not forget there is always this thing to hunt you down. Just open the server, go to ISFC Tropicals. Okay, I'm gonna show you guys what exactly this is. This is like a list of tropicals I made, and it's very cool because it's so cool. Alright, so you just right now we're doing accruals and prepayments. Accruals and prepayments, okay. And here we are, there's 24 questions, okay. There's income statements, T accounts, and some other stuff, but it's all about accruals and prepayments. So, you can start with all of them. The old questions like 2014 and stuff is harder, you can say, and the new questions are also harder because nothing in this world is easy. And yeah, ISOFOC topicals is really good. So, yep, that's it. Now, your screen is very blurry. Send the question. I'm sorry for I mean, like you always want to practice more, right? But like the topicals are nice. You guys should try it. Thanks, thanks, thanks. Uh, I saw the second one is no. Look, guys, try it. Literally try it. Okay. And if it's hard, then of course it's hard. For the Annual question, in my speedrun sessions, no, in my accounting sessions, you can find them. You can find them in the pinned messages. I have explained the Annual question as well. And if you know that you're cooked, then you can just open this and you can find it. And it is over here, accruals and prepayments. And over here also I
Actually,
shared the Annual question and then everybody just got humbled.
this side is complete, right? Do we know that this side is complete? The debit side is
This is me
complete.
explaining accruals and prepayments. Here,
Yes.
So,
cool.
Yeah.
This was just
okay, so the
yeah.
debit side is complete, and on the
I
credit
remember
side, we
these
need to
things
put
so
income
well.
statement. So let's first find the
Oh,
total.
Sir.
this is
So if
wow.
we just
We were doing crazy stuff, bro. You guys should watch the
the opening
sessions. They're like
balance and the
really good.
closing balance,
You can just
the
see
opening balance decreased.
how much crazy stuff we did here. It was
We
income
should log
statement,
it up.
accruals and prepayments mostly. So in accruals and prepayments we had,
Okay, well, so we
but the
have
thing is this
450
is
per
the
month still.
Annuala one that
So
I'm
the
sharing
price
right
of
now, and
rent
this
remains consistent
Grace
at 400 per
Zindi
month.
guy
The price of
is
rates
very
is
annoying,
120
but
per
he
month.
had an income statement. Like we had to make the income statement for that guy, and there were crazy adjustments in that.
Six
We do not
minutes.
take capital in income statement.
You guys need to
Okay, that's
try
enough.
this, okay? Um,
So this
I already gave two questions, so I think that's enough for now. But then, if you ever feel like it, then the sessions are always there.
marks,
Okay,
if you just keep it to this much, then this
this much, then this much. Oh wow, we got so many people now. Hey, I love you, bro. Thanks. I don't want to go. No, I'm here. I'm here. These questions they're amazing. They're amazing. Wait, actually, you're done? Oh yeah. When you open the mark scheme, you will realize that you are done. Like not done with the question. Like you're done. You know. Okay, then I'm gonna go now. See you guys tomorrow. And tomorrow we're gonna do depreciation. And I will also send some depreciation questions. They're all in ITFUSI topicals. Okay. There is very much a lot of questions. See topicals. Then you can just always open this and start questions. All right then. You don't have to mention that. No, shut up. Please explain what. I give private classes, so you should just take classes. Very cheap. I already explained one of them. I already explained the income statement as well. Sure, bro. Whatever. Okay then. Take care, guys. I'm gonna see you next time. Peace.